Last week ranks among the most chaotic in 24 years for the financial markets. The S&P 500 swung like a pendulum today, moving an astounding 8% on Monday and nearly 11% on Wednesday. This isn't just typical volatility. This is full-blown market whiplash. Forget rate cuts or earnings season. Capital is fleeing the U.S., volatility is roaring back, and financial markets are searching for safety like wild animals on the hunt. This isn't merely a dip to buy into. This might be a signal to protect your capital at all costs. Let's decode why. To understand how we got here, let's rewind back to February 2025. That's when the stock market was at its peak. At first, it was mostly big tech companies that began losing value. Nothing too alarming initially. But soon enough, the selling spread to other parts of the market. By the time March ended, even the strong, stable stocks began to fall. Then, in early April, the strain spread to the credit markets, where companies borrow money. The riskiest borrowers issuing bonds popularly known as junk bonds got hit hardest. Investors demanded higher interest rates to lend money, a looming sign of fear in the air. Meanwhile, in the bond market, peculiar things started occurring. The difference between specific borrowing rates, known as swap spreads, grew wider, usually indicating investor anxiety and drying liquidity. In short, the warnings intensified, first in stocks, then in credit, subsequently in bonds, and by April, the market was flashing red all over. Once again, the time-honored 60-40 playbook failed. For decades, the 60-40 strategy, 60% stocks for growth, 40% bonds for safety, was the golden rule. It thrived because when stocks fell, bonds typically rose. That inverse relationship provided balance, stability, and a natural hedge. However, in today's market environment, that relationship has snapped. We're now dealing with a world where stocks and bonds are sinking simultaneously. When risk strikes, there's no cushion. Bonds, once the safe harbor, are now drifting amidst the storm. Investors relying on bonds to offset equity losses are painfully learning that diversification isn't functioning as it used to. And this week, the long end of the U.S. Treasury market, the global finance bedrock, lost its anchor. Goldman's top hedge fund strategist put it simply, the market is turning its back on U.S. assets. Stocks, bonds, credit, and the dollar are all under pressure. It's not only within the U.S., Europe too grapples with negative earnings, caught in the crossfire between China's oversupply and America's tariffs. China's growth forecasts have been slashed, while Japan behaves like an emerging market. Their bond market collapsed, and their banks endured 5 days of sheer chaos. So what comes next? The most significant figure in this market isn't CPI or GDP, it's jobless claims. As long as employment holds, households remain calm. But should that dissolve, the market isn't poised to handle the shock. When the chance of a U.S. recession is a coin flip, protecting capital becomes priority number one. There are times to hit the gas, and there are times to slam the brakes. This is a break moment. But if you seek real-time macro insights that the street won't vocalize, consider subscribing to Macro Junkie. We decode the chaos, ensuring you're not ensnared within it.